Hey everyone, welcome back to Corporate Decoder. Today we're diving deep into Beta Technologies' latest financial report, and let's just say their numbers are about as electrifying as their aircraft. Prepare yourselves, because we're about to decode what might be the most crucial financial period yet for this electric aviation pioneer. And hey, if you love getting the real story behind company filings, hit that subscribe button and join our Discord community, linked in the description below. So Beta Technologies Incorporated has just dropped their quarterly report for the period ending the 30th of September, 2025. This is essentially a mid-year check-in on how they are performing financially. Think of it like a progress report for a student who is in a very high-stakes advanced class. They are building electric planes and all the crucial technology that goes with it. And this report tells us if they are on track. Let's jump right into the financial statements, starting with their balance sheet, which is like a snapshot of what the company owns and owes on a specific day. As of the 30th of September 2025, Beta reported total assets of over $1 billion. That is up from about $666 million at the end of 2024. This shows significant growth in what the company has at its disposal, likely fueled by new investments and the expansion of their operations. And get this, their cash and cash equivalents, that is basically money readily available, ballooned to a whopping $687 million by the 30th of September 2025. This is a huge jump from just over $300 million at the end of 2024. This massive increase in cash is a really good sign, suggesting they've recently brought in a lot of new money, probably through funding rounds or sales. Now, looking at the other side of the balance sheet, the equity section, we see their total convertible preferred stock and stockholders. Equity went from about $435 million at the end of 2024 to nearly $790 million by September 2025. This substantial increase further supports the idea that they've been very successful in raising capital. Moving on to their income statement, which shows their revenues, expenses, and ultimately their profit or loss over a period. For the 3 months ending the 30th of September 2025, total revenues were just under $9 million. This is a significant leap from about $3 million in the same period last year. This suggests their sales are growing. On a 9-month basis, revenues more than doubled, reaching over $24 million compared to about $10 million last year. More sales mean more traction in the market. Product revenue, which comes from selling physical items like propulsion systems and ground equipment, was about $3 million for the quarter, up from less than $1 million last year. Service revenue, which includes engineering and consulting, was about $6 million for the quarter, more than double from last year. This shows a strong demand for their expertise in support services. But with more revenue comes more costs. Their cost of revenues, the direct costs to produce and deliver their products and services, also increased significantly. For the quarter, it was nearly $3 million, up from about $1.2 million last year. This is expected as they scale up. Despite the increased costs, their gross margin, which is the profit from sales after accounting for direct costs, also increased. For the quarter, it was over $6 million, up from less than $2 million last year. This is a positive trend showing they are becoming more efficient as they grow. Now, where a lot of the money goes is in research and development. This is where they're building the future of flight. For the 3 months ending the 30th of September 2025, R&D expenses were over $56 million. This is a slight increase from about $54 million last year. This shows they are continuing to invest heavily in innovation. General and administrative expenses, which cover things like salaries for management, legal fees, and office costs, also saw a significant jump. They were over $30 million for the quarter, up from about $20 million last year. This increase likely reflects bringing on more staff as the company grows and prepares for public operations. All these investments mean they are still operating at a loss. Their loss from operations for the quarter was over $80 million, a bit higher than the $73 million loss from the same period last year. This is typical for a company in this growth phase, where they are spending heavily to develop new technology and capture market share. And here is a really interesting and massive item, a loss on the issuance of convertible preferred stock of over $355 million. This is a non-cash charge, meaning they didn't actually lose cash here, but it is an accounting treatment for the difference between the fair value of stock they issued and the actual money they received for it. This often happens in complex funding rounds where the value of the stock is estimated to be higher than the sale price. It's a big number, but it is important to understand it is largely an accounting adjustment rather than an actual cash outflow. So, the resulting net loss for the quarter was a staggering $437 million. This sounds dire, but remember that huge accounting adjustment for the stock issuance, which significantly impacted this number. For the 9-month period, the net loss was nearly $600 million. Again, this large loss is heavily influenced by that stock issuance accounting. Let's look at the statement of preferred stock and stockholders' equity. This shows how the ownership structure of the company has changed. By the 30th of September 2025, the total convertible preferred stock and stockholders' equity stood at almost $790 million, a significant increase from about $435 million at the end of 2024. This massive jump indicates substantial new capital coming into the company, which aligns with the cash increase we saw earlier. We see here the issuance of convertible Series C preferred stock bringing in over $200 million, and even more with the Series C -1 preferred stock issuance raking in over $724 million. These large numbers confirm that Beta has been very active in raising funds through selling these preferred shares, which is a common practice for growing companies before they go public. Now, let's talk about cash flow. This statement shows how cash moved in and out of the company. For the 9 months ended the 30th of September 2025, the company used nearly $183.4 million in cash from operations. This is a consistent pattern for a company in beta stage, as they are investing heavily in R&D and infrastructure rather than generating positive cash flow from their core business yet. Investing activities, which usually involve buying long-term assets like property and equipment, used over $24 million of cash. This shows they are still acquiring significant assets to build out their capabilities. But here is where the impressive numbers come in. Financing activities provided a massive $598 million in cash flow for the 9 months. This is overwhelmingly due to the proceeds from issuing their Series C and Series C -1 preferred stock, and also proceeds from a sale-leaseback transaction. This inflow of cash from financing is what is keeping the company afloat and fueling its growth. Looking at the 9 months as a whole, the company used $183 million in operating activities, $24 million in investing, but brought in a whopping $598 million from financing. This means they are burning through cash to build their business, but they are very successful at raising new capital to cover those expenses and more. Now, let's dive into some of the notes that explain these financial statements in more detail. This is a huge piece of news. The report is filed after the 5th of November 2025, so it mentions the completion of their initial public offering, or IPO. This is when a private company sells shares to the public for the first time. They raised about $1.1 billion after fees from this offering. This IPO is a game changer for them, providing a significant influx of cash and making their stock publicly traded. We saw this large loss on our income statement. The notes clarify that this loss of over $355 million relates to the issuance of their Series C and C -1 preferred stock. It is an accounting recognition of the difference between the estimated fair value of the stock issued and the actual cash received. This is a complex accounting treatment, but it highlights the significant capital raises that occurred. Beta has also entered into collaboration agreements, notably one with General Electric or GE Aerospace. This partnership, signed in September 2025, focuses on developing propulsion technologies for hybrid electric aircraft. They even issued warrants to GE Aerospace in connection with this. This kind of strategic partnership is vital for a company developing groundbreaking technology, leveraging the expertise and resources of larger, established players. They also discuss new accounting standards they are evaluating. This is more of a technical detail, but it shows the company is staying on top of financial regulations and reporting requirements. One interesting point is the concentration of their revenue and receivables with a few key customers. For example, customer A and customer B represent significant portions of their revenue and outstanding receivables in certain periods. This means that a major issue with one of these large customers could have a noticeable impact on Beta's financial health. It's something investors will want to watch. Beta has also received government assistance, showing up as reductions in expenses for general and administrative, R&D, and property and equipment. This is a common incentive for companies working on advanced technologies in manufacturing, showing a level of governmental support for their industry. The notes also detail significant related party transactions. This includes investments from board members and their associated companies in their preferred stock offerings, and the sale-leaseback transaction with an associated company of a board member. The partnership with GE Aerospace is also detailed here, including the issuance of preferred stock and warrants. It's important to note these transactions as they can sometimes raise questions about fairness and transparency, though they are common in private company funding rounds and strategic partnerships. This section covers events that happened after the 30th of September 2025, but before the report was finalized, we see they continued to issue Series C -1 preferred stock after the reporting period, bringing in more funds. Then, crucially, they adopted 2 new plans on the 15th of October 2025. The Beta Technologies Omnibus Incentive Plan and the 2025 Employee Street OC Purchase Plan. These are designed to attract and retain talent by offering stock options and other equity incentives. And of course, the big one, the IPO on the 5th of November 2025, is reiterated. Confirming the massive capital raise, finally they mentioned granting restricted stock units under the new 2025 plan to employees. This is all about aligning incentives as they transition to being a public company. Now, let's get into the management's own commentary on their performance. Management emphasizes that Beta is redefining the aerospace industry by developing electric aircraft and propulsion systems. They highlight their vertical integration, meaning they control many parts of the process from design to manufacturing to aftermarket services. This allows them to innovate faster and capture more value. They are focused on enabling technologies like motors, batteries, and charging networks, which they believe offer recurring high-margin opportunities. They reconfirm the completion of their IPO and the substantial proceeds raised. This is clearly a major highlight for the company. Management explains that product revenue comes from selling tangible things like ground support equipment and components, while service revenue is from engineering, consulting, and charging station usage. They are seeing growth in both areas, which is a good sign that their business model is gaining traction. This section is about how changes in the market, like interest rates, could affect the company. Beta has a lot of cash, over $687 million. They state that for most of this cash, they don't see a big risk from interest rate changes because their investments are short term. However, they do acknowledge that lower interest rates would mean less interest income, which is a minor downside. They also touch on credit risk, meaning the risk that the people or entities they lend money to or do business with might not pay them back. They believe their cash is primarily held with reputable institutions, so they don't see a significant credit risk there. Alright, let's zoom out and talk about what all of this means. Beta Technologies is in an incredibly exciting but also incredibly capital-intensive industry. They're not just building planes, they're building an entirely new ecosystem for electric flight. The massive increase in cash primarily from their recent preferred stock sales and their IPO is a huge positive. It means they have the financial runway to continue their ambitious development plans. However, they are still operating at a significant loss. This is expected for a company in their stage, but it's crucial that they eventually turn that around. The growth in revenues is promising, but the high R&D and GA expenses are a constant drain. Their strategy of vertical integration and controlling key technologies is a smart move, as it can lead to higher margins and a stronger competitive advantage. The partnership with GE Aerospace is a significant endorsement and could open doors to future government contracts and commercial opportunities. The concentration of revenue with a few key customers is a risk to monitor. If one of those major clients falters, it could significantly impact Beta's finances. Overall, Beta is making big strides in a groundbreaking industry. They've successfully navigated complex funding rounds, secured strategic partnerships, and now have the capital from their IPO to push forward. The key moving forward will be their ability to convert this massive investment into profitable commercial operations, manage their expenses effectively, and scale their production and services efficiently. It is a high-risk, high-reward scenario typical of disruptive technology companies. What is your take on Beta's financial health and their ambitious plans for electric aviation? Let me know your thoughts in the comments below, and if you found this deep dive valuable, please give this video a thumbs up and subscribe for more corporate breakdowns. Don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching, and I'll see you in the next one.